Welcome to the Commercial Real Estate Podcast, powered by First National. I am Adam Pawadic with Aaron Cameron at RealREIT, which kind of kicks off our conference season after a nice and enjoyable summer break, a agonizing summer break. I don't know how you want to describe it, Aaron. Are you excited to be back? Or,
rates are down.
Rates are down. Well, we got something to talk about, which is quite nice.
We've spent the last 2.5 years talking about doom and gloom and what's going to happen. And
this is
I can't remember.
Season.
I can't remember all of the slogans. I mean, the most recent one was "Survive to 25."
Yeah.
There were some others in there.
26 or something like that. Yeah.
Yeah.
A few in there.
So "Survive to 25" seems real.
Yeah.
So far, depending on how many more bank cuts occur or interest rate cuts occur by the Bank of Canada.
Before we jump into it too much, though, we should mention we are doing this as part of our speaker video series, sponsored by Granite REIT.
Boring.
Okay.
Boring. Sorry, Granite. Yeah. Well, and let's introduce Alex Avery while we're at it, all the boring things. No offense, Alex.
All good. Boring's good.
The show's gone very poorly, but
that's okay. That's okay. We've decided to be less professional. It never suited us anyway. Yeah. That's why we're not wearing ties. It's just not our style. I went to an event yesterday wearing basically like khakis and an untucked shirt, and I got called out on it. It was too casual. Yeah. To be fair, I forgot that I was going, and that was just what I was wearing to the office that day. Anyway, don't do what I did. Alex works at you're the president and CEO at Primaris REIT.
The CEO of Primaris REIT.
CEO of Primaris REIT. We will get into recording here at RealREIT. Before we get into all those nitty gritties, I mean, Alex, what are your sentiments coming into the summer months, into September? Are you feeling excited, optimistic? Like, what's the vibe going right now?
Yeah, no, definitely. I mean, we spent a couple of days last week meeting with investors. There's definitely, a renewed sense of enthusiasm for the space. Primaris was spun out 2 years ago when we came into a rising rate environment, capital just fleeing the sector. And so, it's been a tough couple of years from a sentiment perspective. At Primaris, we've been very busy, but I think a lot of the REITs and a lot of REIT investors just haven't been very enthusiastic about REITs. And so, probably started a month and a half ago that it really picked up, and you can really sense a lot more interest and a lot more enthusiasm for the space right now.
Is that entirely interest rate driven, or is there other factors in play that show us a
Who cares? It's just interest rates. That's all that matters.
You know what? I think it's that simple. It really is interest rates, and as I said, in 2022 there was a big sucking sound as capital came out of the space, and there's billions and trillions of dollars sitting in money market funds, and the expectation is that over the next 6-12 months, as you see more and more rate cuts, that money is going to flood back into income investments, and REITs are front and center on that. So. The sentiment last week was really that this is just the beginning.
Where were you before Primaris?
Way back. Go back to the first one.
Oh, yeah, sure. Yeah. And before that?
Cashier at a McDonald's or whatever it was,
I had a ton of summer jobs, all sorts of ones. I was a garbage man for one summer. That was a great job. I started my career at the Altus Group. I was in engineering, went to the Altus Group, worked there for a couple of years, and then I went to equity research. I spent a dozen years at CIBC, which I know you've had analysts on this podcast before, and I think they've even said that it's the toughest job in finance, in real estate, in capital markets, and I would completely agree with that. It's a fabulous job. You get such great exposure to all sorts of interesting people. I spent a lot of time with Ed Sunshine, Tom Hofstadter, Michael. Tom Schwartz, all sorts of really interesting leaders in the real estate space, and I learned from them. And while I was there, I also spent a lot of time working on thematic research, so looking at things like tax policy and the impact of tax policy on strategy.
Sounds riveting.
Like I said at the beginning, boring is good.
Yeah.
So I spent a lot of time focused on that, and then left after 12 years. It was a tough thing to do, to leave a job that I'd been doing for so long, and it was a good job. But I really wanted to get back on the steep part of the learning curve and challenge myself. And so I left in 2017. I joined the board of H&R REIT. At the same time, when I left CIBC, what I really wanted to do was run a hedge fund. So I partnered with a group called Front Four, and that was in 2017. We launched an activist campaign on RealREIT, and became the largest shareholders there. In 2018, launched a hedge fund that I ran for a few years. At H&R, I got more involved in in the business, became a non-independent trustee, did some lease deals, worked on some restructuring of assets, and at the same time was working on this engagement with Cominar. We had managed to really turn the business around by late 2019, early 2020, and the stock was really moving higher. And then the pandemic struck. And when the pandemic struck, everything kind of went crazy. We were the largest shareholder of Cominar. We had raised about $200 million to become the largest shareholder, and we had investors that we needed to support. So we pivoted from an activist campaign to an LBO.
What's that stand for?
Leveraged buyout. So we took Cominar private. We actually completed the deal in March of 2022. It was about a $5.7 billion deal. In parallel to that, I was on the board of H&R, but I joined the management team as well and worked on a number of restructuring type activities. So we did a series of transactions around the Bow, the big office building in Calgary, where we took the lease, restructured it into an amortizing 17-year bond, and sold it to some institutional investors. Took the building and some of the rent and sold it to another group, and then kept some of the rent. And then in parallel to that, worked on the spin out of Primaris, and ultimately went with Primaris in December of 2021. When we spun out, I joined Primaris as the CEO.
Outside of CEO of Primaris, and you've had a wide variety of experience. What was the most exciting position in the last 20 years?
I in terms of excitement, in the second half of 2021, I went from, if you were to be critical of the analyst job, it's kind of like an armchair quarterback. You get to evaluate and study all of these other guys who are out there doing it. And I kind of made this transition. It was 5 years, but, it's an overnight success that takes 5 years, kind of a dynamic. And in the second half of 2021, I went from a guy who had never really been a principal on any deals to completing $10 billion of deals in about 3 or 4 months. So that was pretty exciting. That was a real transition personally and from a career perspective, to go from, I think this is how you do it, to actually doing it. And that's been really interesting. And in a very real sense, Primaris is the culmination of having studied the way that other people have done these things, all of the people I mentioned before, Dory Siegel, Bruce Flatt, there's all sorts of people, Mitch Goldhar, that I've spent a lot of time with.
You got to learn from their mistakes and try to avoid them, I guess.
Yeah,
right?
their wins and their losses. And what's great about it too, like the sidebarring, Michael Cooper has done a lot of transactions, and you sit and chat with these people and you ask them, the off-the-record questions, and you get to understand how their thinking worked. And then you compare series, many, many different case studies. And then I brought all of that to the design of Primaris. So we really, had a very unique opportunity to basically design Primaris from a blank slate. So talk
about the spin out first, just so we can get the sense of what because you weren't starting from scratch, fortunately.
Yeah. How
did that work, the spin out? And how did that exercise take place?
Yeah, so it was, I had a pretty good relationship with Tom Hofstadter when I was an analyst covering H&R. I joined the board when I left the sell side, and pretty quickly, our ongoing dialogue that had started years earlier, became a little bit more open, because I was no longer writing research about the company. I was a part of the board, and he and I spent a lot of time talking about, how we could restructure the business, which had grown and grown and grown through a very robust growth period, into something that was more in keeping with what investors wanted to see, so that you can get a cost of capital. The REIT business, at the end of the day, is really an exercise in cost of capital. So you need to offer what investors are willing to pay for. And it sounds fairly straightforward, but sometimes what they say and what they do are different things.
Is that kind of, I'm sorry, maybe translating or mistranslating your words, but did they just get too diversified? Is that
yeah,
basically?
Yeah.
Mm-hmm. So you had no I guess no narrative for why buy my stock. It's kind of like it's everything, and that's not a good narrative. I don't know. You tell me.
Well, and what had happened specifically with H&R was it's everything included a mall business, and the mall business going into 2018, 2019 when we were having a lot of these strategy discussions. Was very, very out of favor. I mean, the mall business, you had in Canada Target, you had Sears, you had e-commerce, and then ultimately you had the pandemic, and it was like, 1,000-year storm for the mall business in Canada. And so, when even regardless of what your views were on the mall space or on any of the other property types, the Bow office building, a 2 million square foot single tenant office building in Calgary with a commodity producing company that was the largest company in Canada when the deal was signed. It didn't really matter. It was just a lot of different things. And so when we were talking through that, it was, what makes sense to pull apart, which pieces can stand on their own. And the mall business was one that very clearly could stand on its own. Initially I was hesitant to get involved in Primaris because the mall business was facing such, I think.
Well, retail is dead, and we've had that conversation so many times on the podcast, right?
Well, and being as close to it as I was, I spent a lot of time with Pat Sullivan, who's our president and chief operating officer, all the way through 2017, 2018 through till today. We're partners running Primaris today. And, when you're that close to it, you can see the difference between what's happening on the ground and what the narrative is. And in 2017, 2018, they were pretty aligned. And then you could see the mall business really inflecting and coming back just prior to the pandemic. Things were getting really much, much better. And then the pandemic struck, and that just took everything down from a value perspective, from an NOI perspective, from an occupancy perspective. But you had a real sense of confidence that this e-commerce threat wasn't really a threat, and that omni-channel is really it's a complementary type of a dynamic rather than a substitution dynamic. And so you could tell that the business was really strong. And so when we went into the pandemic and we were looking at, taking further steps to de-diversify H&R, the opportunity at Primaris just became pretty spectacular. And the idea that we could design it from a blank slate. I mean, I spent all these years writing these boring reports and my wife would agree with you on that point, about, governance, about leverage, about how you use an NCIB, the value of NAV as a valuation tool when you're analyzing REITs, all of these different things, and brought it to the table as we were sitting down, a group of us, Pat, myself, Tom, and a number of others, and really created what, in my mind was a best practices across the board type of a REIT. And it was such a unique opportunity, just very fortunate to be there at that right time where you're coming off of a 1,000-year storm right out of the gutter. Sentiment is extremely negative. There's nothing better in the world than low expectations. I mean, when people have low expectations for you, it's very easy to outperform. We went to, right after we spun out in 2022, we went down to Miami for a Citigroup conference, and we met with this South African investor. Had never met him before, had a good meeting with him. He told us that his strategy when he went to these conferences was to just meet with companies that he'd never heard of. So we fit the bill because we were brand new. We went back the second year and he walked into the room and he's like, "You didn't go bankrupt."
Yeah. Well, you probably see some that did go bankrupt, right? If that's your strategy, it's...
and we were in the mall business, but that was a great start to the meeting. Cause it's not only didn't we go bankrupt, but we did a whole bunch of stuff.
Invest in us. We won't go bankrupt. Yeah, there's your pitch.
Well, all the data post-COVID is really strong in retail. I mean, obviously COVID is a really unique situation. If you take that out of a timeline, the idea that retail's dead is just
that's a good question. Are we back to pre-COVID levels? I mean, I know it's changed, and we've talked about Friday visits and weekend traffic and how it's all, you can't really compare it directly because it changes a little bit because of the work from home and the hybrid working environment we're all in. But do you think the overall sort of fundamentals are kind of back to the same basis as they were pre-pandemic?
Our fundamentals are incredible. Sales are 20% above where they were in 2019. Our occupancy is up 700 basis points over the last couple of years. Same property NOI growth in 2021, the year going into the spin, was 10%. The next year it was 10%. The next year it was 5 to 6, 5.4, 5.7, something like that. And I think we're on track to be, somewhere in the, 3, 4, 5% range this year, which is pretty strong. And
is that unique to you guys, or is that kind of the? And I'm not taking wind out of your sails, but is that the market at large, and are you outperforming the market? Maybe is the better way to ask it.
Well, I mean, we'll probably talk about it, but one of the things that Primaris has been doing is buying malls from Canadian pension funds. And I would say, the pension funds that we're buying malls from are seeing the same kind of performance. The mall business is strong. The reason that the vendors are selling us malls is not because they don't like the malls. It's because they have portfolio construction ambitions. Pension funds typically have very long-term investment horizons, which is great for owning malls. They're very long-term assets, and the REIT structure actually is the perfect or the ideal ownership structure for malls. But the pension funds have these very long-term investment horizons. And so if you go back 15 years, Canadian pension funds basically just invested in office and malls. And that was because at the time, apartments, there wasn't the new modern quality of apartments, and you had Toronto Star articles every 6 months about 10 people living in a broken down apartment owned by this slumlord, and there were rats and broken windows and no heat and all of that stuff. So it wasn't very attractive. Industrial wasn't very attractive because the rents never really grew, which subsequently changed.
We're back to that thesis now, though, probably. Anyway,
yeah,
everybody's a genius looking backwards, right? Yeah,
we can touch on that in a minute. That's an interesting point. But the other property types that they're now very interested in didn't exist: data centers, cell towers, life sciences. Like there's it's a much broader menu, and pivoting. If you're an equity investor to buy one REIT, sell one REIT, move your portfolio is pretty quick and painless. For a pension fund, like you're talking chunks of $300, $400, $500 million, and trying to coordinate that is very challenging. So, in a very real sense, Primaris is a vehicle designed to restore liquidity to the Canadian mall market.
Was that why you said the REITs are the perfect vehicle for retail ownership? Is that the reason why?
Well, not just retail ownership, but specifically for mall ownership. Okay. Malls are a very specific and unique subset of retail.
I'm putting my hand up. Sorry. What's a mall?
An enclosed shopping center.
Okay, thanks. I just want to make sure we're talking about the same thing, because there's a lot of different iterations or definitions. You're talking about enclosed.
Yeah.
Okay.
Yeah, so we do own some unenclosed properties, but those will be non-core, and we're in the process of selling.
So everything you're talking about, when you talk about malls, it's enclosed malls. Okay.
Yeah. We're very focused on specifically the enclosed shopping center. Most of our malls would be somewhere between 400,000 or 500,000 square feet and 1 million square feet. We have, ideally somewhere between 100 and 200 retail stores in the mall. And generally speaking, what we're targeting from a strategy perspective is the dominant retail node in the market. Okay. And if you have 400,000, 500,000, 600,000, 700,000 square feet, generally you're going to be the biggest retail node in the market. But a big part of our strategy is being the best mall in that market. And just when you think about moats around businesses, the fundamentals of the mall business are just incredible right now, in the sense that you have many of the third and fourth malls in the market, and even the second malls in the market, being bought by investors that see a higher and better use. They think it's a residential redevelopment or a mixed use redevelopment. And so what we've actually seen is the mall GLA per capita in Canada peaked in 1991, and it's been gradually coming down ever since. So for the past 33 years, you've seen lower and lower mall retail space per capita. And from 1991 until 2016, you went through this period where I would say it was basically like very limited new mall construction and decent population growth. So that per capita number was coming down. And around 2016, we've got this slide in our investor presentation. You can see the rate of decline starts to accelerate, and that's where you're taking things like Pickering Town Center and you're tearing down a wing, building apartments or condos, doing the same thing. There's the amazing Brentwood out in Vancouver and Lougheed and Erin Mills Town Centers head in that direction. There's dozens and dozens of examples, and what that does is it just reduces the inventory. So you have this demand is strong and the inventory is shrinking. And then when you think about trying to add new supply, which no one's really, there's one case in Montreal where there's a new mall being built, but if you really wanted to add material new supply, firstly, it's $1,000 a square foot, $200 of land, $800 of building to build a new mall. But our enterprise value is $240 a square foot. Our rents would have to triple before you could have someone justify building a new mall. And then if you did have that set of circumstances, you would then have to find 40 or 50 or 60 acres of land.
Surrounded by people.
Yeah,
exactly.
It's not like industrial. You can just build it an hour outside of the downtown. It's
so when people
you basically need to buy a mall to build a mall.
Yeah,
exactly. People throw around the word irreplaceable pretty easily.
Oh, I see. You were demauling, now you're remauling.
Yeah, exactly.
Well, the other part of that equation too, of course, is population growth just skyrocketing. Even if we were building new malls, the idea that it would be on the same growth curve as the population in Canada would be tough to keep up with.
It certainly would be, but we're so far from there. I mean, I think we have a really, really long runway of growth in our business, and we're still very active on the acquisition front. We're also active on the disposition front. We're really, when you think about the evolution of REITs, there's, the early stages, and then there were a whole bunch of phases, but where we are in that evolution of how investors and REIT management teams design and meet and provide what they want. When I said, it's an exercise in cost of capital, you need to give investors what they want. What investors really want is a sharpshooter that's a specialist in their specific property type, where they have some sort of a value add, a specialty that is, not easily replaced, and that's that's exactly what prime
and focus, right? Like you're focused on one thing and doing it the best you possibly can, rather than being kind of spread out.
Well, I'm sure we've all seen those business cards, whether it's an appraiser or a real estate agent, because I specialize in names all 4 asset classes plus 3 kind of sub asset classes. Yeah.
What's the smallest town you'd go to, size wise? You don't have to name a specific town, but what would be the
Well, so it's interesting. We have a pretty open book about our acquisition strategy, and we identify a number of characteristics around the malls. CRU sales of at least 80 million, which generally makes you, one of the larger retail nodes in the market, but we really want to be the number one retail node in the market. We say, minimum of 100,000 people, but if you look at the acquisitions that we've completed so far, and we are very active on a number of additional acquisitions, they're typically in markets that have, 5, 6, 7, 800,000 people. And then, we are looking at things in the big 6 markets as well. We do have smaller markets, and being the dominant retail node in a market is great, provided you have a diversified economy, so you're not a one-horse town. You want to see population growth, you want to see the infrastructure, and so when you look at the markets where we've been buying things, it's places that are the attractive places. If you were, I'm sure you guys both have friends who have decided to leave Toronto or leave other, big markets, and they don't go to Coboconk. No. They go to Halifax. They go to
Calgary.
Calgary.
An hour out of
markets where.
How many malls is that? Like, you could probably count them all pretty quickly.
So there's about 175 malls in Canada. About 50 of them we wouldn't really consider. They're the 100, 200, 300,000 square foot malls, and they're like the 5th or 6th mall. So there's about 125 that we really look at.
How many do you own today?
We have 25.
Okay. So you got 100 more you could get after.
Yeah, well, so out of that 125, there's about 70 that probably don't meet the criteria of being the number one mall in the market, and don't have a lot of the other characteristics we're looking at. So there's about 50. We own about 25 of them. And we're very active in discussions. We're currently engaged on 5 or 6 malls out of that 25 that we're targeting. And when I was talking about the way that management teams and investors needs to meet and you need to deliver, what we're trying to do at Primaris is build a sustainable competitive advantage where we have what we refer to internally as the first call for retailers. So we frame our strategic ambition that way, and we say when a retailer wants to come to Canada, we want them to call Primaris first.
Right.
That's not necessarily the case right now. You've got some pretty impressive other landlords that have malls like Yorkdale or Sherway or Square One, or there's all sorts of them across the country. But what we offer is a pretty much a blanket approach. You can come to us and you can open up 25 stores across the country. And as we're going through our strategic evolution, we're selling some of the malls out of some of the smaller, less competitive properties that we have, and we're adding at the top end. And so we're just trying to establish ourselves as, the first call for retailers as they come to Canada.
Given Canada's population distribution, you mentioned 500,000 is kind of a minimum threshold for investment. And of course, that limits the number of places you can actually invest. Would you ever contemplate looking at breaking that threshold in a meaningful way, just because the list of cities that meet that criteria of 500, it's not like the U.S. where you have just endless supply virtually. It's a pretty short list of cities that actually hit that target.
Yeah, I mean, we do have a lot of malls in markets that are sub 100,000. Not a lot. We have a few malls that are sub 100,000 populations.
But you wouldn't acquire there now? Is that the idea? Like you wouldn't look to grow there?
That's one factor that we look at, but the total sales volume, the draw, like there are malls like we wouldn't, I don't think it's for sale, but the West Edmonton Mall is a really interesting mall. So it's in Edmonton. It doesn't really cater to people that live in Edmonton. It caters to all of the people from Fort McMurray and Grand Prairie and all of these other places. It's 6 million square feet. It's got an amusement park. It's got a water park. It's got a couple auto dealerships. Like, it's a very different profile. And I bring that up just because one size doesn't fit all. There's a lot of different characteristics that you need to look at. But I would say, generally speaking, I would be surprised if we were a buyer of a mall in a market below 200 or 250,000 square feet. Just so happens the ones that we've found so far are more, 5, 6, 7, 800,000. And some of them are in the big 6 markets as well.
One of the strategies we've heard, and I guess I subscribe to, is there's a lot of excess land around malls, and I, to be fair, I mean, I live near Sherway, and I visited others. At peak times, those parking lots are full, so it's not like they're a total wasted space, but they're probably full once every month, maybe, depending on the ebbs and flows of the traffic. Is a strategy to intensify that excess land?
So we own over 1,000 acres of land across the country.
How much of that is just parking lot? Like 70% of it's parking lot, probably, something like that, right?
About 70% of it's parking lot, which generates no revenue for us, but it does support the malls. So, when I talk about what investors want, they want sharpshooters. We're not a residential development company. I would be shocked if we were to act as the principal building a residential tower. We're not going to do that.
Guys.
The real focus for us is the malls. And so, to the extent that we find that we have excess land, we're happy to take it through the zoning and entitlement process and then sell it to someone who is going to build residential there. And that helps us in a few ways. One, it gets us cash that has no associated income with it, so it's very accretive to our business. To the extent that they're increasing the local population, that helps our retailers. But we're not going to be the principals building these apartment buildings. There's, I think inevitably at some point we'll end up in a situation. We own Dufferin Mall. Dufferin Mall has 4 acres of land that are severed, zoned, and titled. And, there's lots of residential developers that would love to.
You could hold a piece, couldn't you, and just be kind of quiet on it?
So we could participate on a passive basis, but it is not part of our strategy to be a residential developer. We're not trying to build a platform. We don't want to have the management capability. We have the mall management capability.
Stick to your narrative.
And that is
stick to your focus. You exist because you needed a focused narrative, and if you start doing that, you're getting off the script. I hear you.
And put some gas stations in there too.
Yeah.
Self-storage at the back. And
Put a data center in the old Target space.
Now you specialize in everything.
You do that.
Check out my business card.
Yeah, my partner Pat often gets questions about that, and he says one of his favorite responses is like, it's like showing up at work in your track pants. Like you've given up at that point, and like we're focused on the mall. We're not trying to find something else to do. We think the mall is a great business, and we have a very scarce management capability. Pat has been running this business. I mean, I'm new to the business, but he's been at Primaris since 2003. And he has been running it, and there are very few people who have his skill set and his expertise. And in terms of platforms, the mall business is really unique in that it is a real scale business. Owning one mall is a terrible business plan.
Yeah, sure.
Lumpy capex. You don't have the scale to support the management capability.
Well, and like you said, you need the retail relationship so that when
tenants
someone
don't
comes
care
in, you got to throw 25 around. You can't just say, "Hey, come here, you get one space."
Specsavers is an interesting retailer. They came to Canada with a business plan 2 or 3 years ago to open 220 locations. The last thing they want is 220 relationships.
Yeah, exactly.
So they came to us. We've got, I think, 17 or 18 done. We'll do 25, and then as we buy more malls, we'll be adding those in, and that really is, the scale of the platform, the management capability is a real competitive advantage that we have, and there's really today only Oxford Properties and Cadillac Fairview that have that same capability that we have.
We're almost out of time, but we haven't really talked about the real sort of nitty gritty of malls yet. And so can I throw some stuff at you, maybe a little bit rapid fire here to get through it? So there are no more anchors. And that, how do you manage that? I mean, I know there are some still out there, but Nordstrom's left, Target came and it's gone. There's the Bay, but I don't think anybody goes to a mall just to go to the Bay. Like that's not the driver to go. How do you handle that? And those are large spaces to fill too, right? I think a lot of your colleagues and yourself probably are managing some big footprints of space that isn't easy to demise.
Yeah.
What's the strategy there?
Well, so it's interesting. I mean, the anchor concept dates back to the 50s, 60s, 70s, where the department stores themselves owned the real estate development companies that created the malls. So they
Makes perfect sense.
They made a lot of money off of it. They knew they were drawing a lot of traffic, so they built additional retail space, and then they benefited from the value that was created there. That really was sort of like a, kindling for the beginning of malls. But it's been a long time since you had an anchor that really functioned as the anchor did back in the 50s and 60s, where most people came to the mall to go to, Sears or Eaton's or Simpson's. HBC would be the logical remaining conventional department store. So they're not really that relevant. What was really interesting was the experience of having Target, which took out Zellers, close and exit Canada, and then have the same thing happen with Sears. And there have been a lot of lessons learned there. And there's a lot of nitty gritty on that part, but you're making an interesting decision when you take a vacant department store. You can either re-demise it as CRU, and if you're doing that, you're really materially increasing the size of the mall. When you think about the share of the local GDP that you're expecting to collect, the department store that was failing probably did $100 a square foot in sales. If you're expecting to do $700 a square foot in sales out of that same space, that's like increasing the size of the mall by 25, 30%. And when you think back to 2014, 2015, 2016, 2017, 2018, like e-commerce was a threat. And at the same time, a lot of landlords decided like, we're going to expand the mall. And that was one of the reasons that malls got so out of favor. It was, not the right decision. And the right decision is different in each mall and each market. But I would say definitively between when Target went down and today, we have a very different view of how we would handle that. In fact, we have a pretty comprehensive plan for every department store box in our portfolio. And a lot of them are just tear it down, recapture some
more
of that
parking space.
Well, more parking space, but also, you can put all sorts of stuff. You could build apartments in that excess land, sell it to someone else.
Data centers is the one that I think I've heard of the most.
At malls?
Yeah, using that space as just as a data center just to generate some revenue. The one I heard most recently was a pickleball club.
Yeah.
and taking that space and turning it into a pickleball, of indoor sort of temperature controlled pickleball space. And I think those are all kind of creative and niche and not necessarily long term.
Listeners can't see it, but Alex is frantically taking notes here with your
No, he's
ideas.
looking at me like that's a stupid idea. Grocery stores, I guess, is an easy fit too. But does that drive? Is that attractive? Like you don't see, at least in the GTA, you don't see a lot of grocery stores in malls. Why is that?
To reframe the last question, I think what a lot of people did when Target and Sears went down was they said, I have a box.
Yeah.
What am I going to do with it?
Yeah.
And I think what now is the approach is I have a mall, and how do I make this mall better? And that might be tearing down that box and, putting in, we have a former Sears at Devonshire and Windsor. It's 200,000 square feet, 3 levels, including a basement. And it was just,
it's a lot of space.
Dead weight at the end of the mall. So 2 months ago, we tore it down. The space inside the mall that went up to what used to be the entrance to Sears was really suffering because you walk down the hall and then there's just drywall. So we tore that down. We've got 2 junior box stores that are going in the end of the mall, which is where you used to go into Sears. They have interior, exterior access. They can control their own hours. They pay us high rent. They're quite good retailers. And then we've absorbed some of the CRU. That mall is a pretty large mall given the size of that market. And so we're just tightening up the mall, and then we get 18 acres of land at the end of the property. It's a 72-acre site. It's a giant site. But now we have 18 acres of excess land after the parking field where we can do any number of things. Yeah. We're exploring a lot of different opportunities. And I don't know if you guys have been to Windsor, but Windsor is on fire.
Yeah.
I've heard. Yeah, I've not been by
and
numbers.
Detroit's on fire. Inside those stories go hand in hand.
Yep. Any malls in the portfolio looking at expanding the actual total square feet of retail space?
I wouldn't say materially. We do have some redevelopments underway. One in Calgary, we have Northland Village, which was a mall. I don't know if you guys ever watched The Last of Us, the HBO series. You know the scene in the mall where they go into the arcade and that was Northland Village.
Okay, cool.
Yeah. And the great thing was they paid us.
Did you get an extra part in that?
I did not play a part in that, but they did pay us $500,000 to rent the mall out to do that. And the best part was we didn't have to ask the retailers to leave because they'd already left. So that was a dying mall. And it was a dying mall because right down the road, there was a much stronger super regional mall. So we've demalled that, and now it's one of the best power centers in the country. The lineup of retailers is fantastic. The location is actually even better than the super regional down the road, but it just couldn't compete. And so, when I talk about that declining inventory per capita, like we're a part of it as well. Not every mall in our portfolio should continue to be a mall, but what we're in the process of doing is getting to that point.
Can I give you one last thing? This is the kind of a half comment. There's a data point for you. Mm-hmm. It's one person, my wife's opinion on malls. And she gets frustrated to a point, more angry than I think she should on this, but she's always very frustrated that there are no gyms in malls. She's like, if there was a gym in that mall, I'd go to the gym every day and walk around with my latte.
You see LA Fitness in the open air malls, but open air retail. Yeah, not interior.
I'm curious. Maybe she's very myopic. Obviously, look at the 2 malls that are in our neighborhood. But do you have malls, or have you expanded to gyms in your mall?
We do have gyms in a number of our malls. Really, what drives our tenant mix is the Canadian consumer. And so to the extent that there are retailers that will pay us the most rent, those are the ones that get the space in the malls. Gyms
don't pay very much.
Not as much.
You need seconds. Yeah. Maybe there's the top floor of that old department store that you no longer.
Yep. Well, and you mentioned pickleball. We do have one pickleball deal underway in a lower level former department store box. It's sort of a test trial for us, and we have a number of people on the Primaris team that are very, very enthusiastic pickleballers. I haven't played myself, but it does look like a lot of fun. But I'm not anticipating pickleball to become a big part of our retailer
or gyms for that matter. Sorry, Stevie. All right. Thanks for surviving through the noise. It got really noisy there for a little bit. There was a fire alarm. I'm assuming the listeners heard that too. And you went right through it as well. So well done. Thanks to Granite REIT for sponsoring this episode, part of our speaker video series recorded here at RealREIT. And thanks to First National powering the podcast. Again, Alex, thanks very much for coming on. That was great. Really appreciate it.
Thanks for having me.